The focus of today's video is relatively simple. Let's not get distracted with the whole kerfuffle between Donald Trump and Elon Musk. So I have two main things to share. I think firstly, as the title probably already suggests, it's not clickbait, it's true, I've reduced my overall Alibaba exposure, and I'll talk more about that later on. And secondly, I'll be diving deeper into two of my portfolio companies that recently just reported their earnings in the past 2 weeks. The first company is Lululemon, while the second is Meituan with the ticker 3690 in the Hong Kong exchange. So to address the elephant in the room, let's go through my recent drastic portfolio movements. So I've recently been really in love with this portfolio software tracker called Potsado. I'm not sponsored by them, but just wanted to put it out there. Clearly, they allow me to do a very apples to apples comparison, comparing to what happens if I invest my capital in the S&P 500 while running a parallel portfolio of my existing allocation. So yes, I'm still underperforming the S&P 500, but I'm relatively comfortable with where I'm at. So in full disclosure as well, this is the dashboard of my current allocation, sizing, how much I have with them, etc., etc. So performance-wise, on a money-weighted return, my portfolio is at 12% annualized, while the S&P and Nasdaq is still pulling their weight ahead. But that said, I think for long-time viewers, most of you are probably wondering, what happened? Why did I sell out of my Alibaba position? So I sold out Adobe and I sold out the US Baba position. And looking at the current allocation, I actually have 15 holdings, but 2 of them are ETF. And largely speaking, you can see that I'm concentrated in the consumer cyclical and also the communication services industry. For those of you who have been following, I've actually made a previous video with the title 9 stocks make up 25.39% of my portfolio. And I've actually went back to rewatch the video 2 times. And coming from a third-party perspective, at least I try to be objective when viewing my own video, I can tell that I'm actually starting to turn bearish on the entire Adobe bull case. And in fact, I do see a stronger and stronger bear case around how AI is actually disrupting the entire design workflow. And Adobe, even though I still believe that they have a very strong moat, at least in the enterprise design solution space, but I really don't know how things are going to play out. I think both Google and Adobe's story has been impaired, both leading the charge by the entire AI disruption. And fortunately or unfortunately, I was pretty impressed in the recent Google I/O conference with their Veo product, which basically pits itself against companies like Adobe. So it was a very easy switch because both are undervalued, and in fact, Google might be going in to snatch Adobe's lunch. Now, moving on to Alibaba. Why did I sell Alibaba? So the main motivation of this switch actually came from that same video. There were a few things that were bugging me since the dawn of time. I don't know why I'm holding 2 counters. They still levy a dividend tax on me, and more importantly, I still have to pay meaningless ADR fees when I have access to the Hong Kong market. So might as well just switch everything out to the 9988 counter in Hong Kong. But that said, I think on an overall portfolio level, my Alibaba exposure have decreased. Initially, I held 187 BABA share, and we know that the stocks are completely fungible when comparing to the US and Hong Kong counterpart. So 187 is equivalent to around 1,500 9988 shares in Hong Kong. I actually sold out of the entire US position, but only bought back 800 shares. And the rest of the capital is actually recycled into Tencent and Meituan. So when you look at the current exposure, even after the so-called recycling, Alibaba still sits very comfortably as the first place with 26% allocation, Tencent at 17%, and Meituan at the 6th position at 6.35%. So yes, I think it's safe to say that I'm still a huge Alibaba bull, but maybe not as bullish as before, I think on a relatively scale. I think previously, when you compare it on cost, so even after this divestment, it's still 29% on cost allocation. And when I really think about it from a portfolio allocation perspective, I always had that conundrum when comparing between Tencent and Alibaba. I know that Alibaba is hugely undervalued, but the company's business and fundamentals have not really recovered as strongly when compared to Tencent. I think Tencent over the past 4 to 6 quarters has really recovered greatly in terms of their growth margins and stuff like that, and the share price do reflect that recovery or that turning point. And since I'm already doing this switch from the US to Hong Kong counter, I might as well also look at the portfolio allocation. And yes, we can go down the rabbit hole of debating that Alibaba is going all in into AI now. There's also a huge long runway of growth and tailwind ahead for them, and I don't discount that fact. That's why it's still number 1. But I think to, in a way, diversify the approach, since all of them are in the Chinese tech space, I don't necessarily see it as losing out in terms of exposure. And since we're already on this topic of portfolio allocation, I'll share 3 simple frameworks that guide my investing decision. I think the first test is called the sleep well at night test. And even in a very uncertain world like the financial markets, you are still able to sleep very well at night because you know that you have done your homework and you have a certain level of conviction. Moving on to the second one, which is what's the first thing you check test. It allows you to have some sort of an indication into understanding what is your priority. And I think you can really kind of see some sort of a behavioral pattern when the first thing you wake up is to check the stock market and how it performed last night. Might kind of call for some sort of a concern because maybe you are investing too heavily, you are putting too much money on the line and you don't feel comfortable and you always feel the need to be looking into your portfolio. And the last test is called the restart test. And to me, that's what mostly affected my recent decision. And you have 0 positions. How would you build your portfolio from scratch? And this allows you to have some sort of an emotional check into understanding whether you will rebuild the portfolio in a similar fashion or what changed. Is your number 1 position too big? Do you want to allocate more to XYZ position instead? And how do you kind of draw the balance? And with that in mind, just a quick plug for Longbridge. It's a new broker in town, regulated by the Monetary Authority of Singapore. And for my Singapore viewers, right now, if you sign up for a new account with the link below, you can enjoy a lifetime $0 commission for US, Hong Kong, and Singapore stocks. And at the base tier of depositing 2,000 Singapore dollars, maintaining it for 30 days and completing 3 buy trades, you get to enjoy half an Nvidia share, the 6% interest boost coupon, plus another 6%, which is the Longbridge partner exclusive, and the $18 cash coupon. So altogether, you are looking at rewards worth potentially up to $160 on your initial $2,000 deposit. So for those of you who are interested, all the information will be in the description box down below, and you can just click the link to sign up. And thank you Longbridge for sponsoring this video. So let's go to the second part of this discussion. Lululemon actually cut their full year earnings guidance, citing dynamic macro environment. And this 20% drawdown is really the difference between the earnings guidance of roughly 40 cents earnings per share. But if you were to scope it down to look at Lululemon's current problem, looking at a snapshot of their Q1 earnings, I think it doesn't necessarily warrant a 20% drop, but I do think that investors are probably freaked out by a few things. First, of course, we have the guidance. So I think they kept the revenue guidance stable, but they decreased their earnings per share, citing margin compressions, mainly due to tariffs. Second, I think we're also seeing significant slowdowns in growth in the US market specifically. And third, I think inventory build-up for an apparel company like Lululemon might actually mean a longer conversion cycle. Sales are probably affected. They're not moving products as quickly as they used to. And there could potentially be some sort of a write-down or even further margin compressions from here out into the future, because if they're unable to sell their previous inventory, they have some sort of an R&D, they have new product lines, then they have to go through some sort of a sales, which will then lead to a decrease in margins in the future. So I think when looking in terms of their EPS guidance, this was what management has to say. So by region, I think we continue to anticipate revenue in North America to increase in the low to mid single digit, China mainland to grow in 25 to 30% range, and the revenue in the rest of the world segment to increase about 20%. So for the full year, we now expect gross margins to decrease approximately 110 basis points versus last year. So we expect the additional 50 basis points of deleverage to be driven predominantly by increased tariffs. So I think for now, on the surface level, Trump's tariff could be a convincing reason because Lululemon is not the only retailer that's going to be impacted. But I think people or investors, we are all probably worried about whether this margin erosion is cyclical or structural. Meaning to say, is this just a short bump in the road, or has Lululemon already seen their peak in terms of margins? And it also calls into question the strength of the brand, since they are unable to pass the cost down to consumers, i.e., I think the lack of pricing power. So looking in terms of their margin picture, just 5 years ago in FY 2021, gross margins was at 56. In the trailing 12 months, they were at 59. Operating margins, same story. From 18%, they grew to 23%. And clearly, you can see that this is a pretty high quality company because I think as the company scales, most investors are expecting a decrease in margins. But for Lululemon, they can grow top line, they can grow their base, yet at the same time still continuously extract greater amount of profits from their customers. And on that same note, I think it's pretty interesting because from the management's commentary, they say that we are really looking at this as operating from a position of strength, being strategic in our pricing, looking at our elasticities and where we have opportunity. Most investors probably think that if the company is pricing power, they will levy all this increase in costs down to their consumers downstream. But from Lululemon's case, they think that they're operating from a position of strength so that they're able to withstand or insulate some of these cost pressures to the end stream customers. I think at the end of the day, time will tell whether this is better in terms of capturing more market share or whether it's just an erosion in terms of brand value. And now, to break down their numbers, total revenue actually grew 7% or 8% on a constant dollar basis. The Americas net revenue increased by 3%. Comparable sales actually decreased 2%. China mainland increased 21% and rest of the world increased by 6%. So clearly, I think there is a growth deceleration in the US, which signals some sort of maturity. I think they also cited in their earnings that store traffic is weak and they attribute it mostly to macro-sensitive customers, which actually takes some time to prove because this is really based on the commentary of the management team rather than a consistent quarter-on-quarter kind of comparisons. So it could also suggest that they are hitting a geographical growth ceiling, probably all concerned about whether there's any potential to reignite US comparables via newness, pricing, or even other penetration ideas into new markets. So when looking in terms of comparable sales, the Americas region actually seen a negative year-on-year growth rate, meaning to say the previous customer base have actually spent lesser compared on a trailing 12-month basis. So is this the first sign of Lululemon losing its appeal? I think it's a little bit too early to tell, but it's definitely some sort of a red flag. Or in some sense, you can call it an orange flag. So from the discussion with analysts, the management team did say, and I quote, "But my sense is that in the US, consumers remain cautious right now and they are being very intentional about their buying decisions. But even with this, we gain market share across both men's and women's in the premium wear markets in the US. So we did see a decline in store traffic, particularly in the US, as we move from Q4 into Q1. And the conversion trends actually remain relatively consistent." And to add on, I think an analyst actually quizzed the management team. Could you elaborate on the slight increase in markdowns now contemplated in the full year outlook? And Megan, which is the CFO of Lululemon, said that in terms of markdowns, which is probably a bigger concern down the line because we're afraid that Lululemon is unable to move products anymore and they have to write off or write down many of their existing inventory. Megan said that we did actually see a decline in markdowns in the first quarter. So a decline in markdowns means that they're still seeing healthy conversion rates. But in her words, given consumer confidence and macroeconomic concerns as we move into the second half of the year, I think we feel that it's prudent to take up our forecast slightly on the markdown line. So yes, this management team is on the much more conservative end. So when looking at Lululemon's valuations today, on the left side is the past historical 5-year numbers. And when you look at their cash flow from operations growth, it's a little bit haphazard. But when trying to compare their free cash flow to their revenue, you can see some sort of a pretty consistent trend. And they range between 13 to 17%. So when doing out a projection for the next 5 years, I just did a growth rate on the cash flow to between 8 to 10% and the capex to be a consistent 8% out into 2030, and I applied a terminal free cash flow multiple of 18 times. And when you look at the last 5 years, their historical free cash flow multiple is between 20 to 30. So as I think growth slows down, I think a lower multiple is being assigned to the company. But I do think that in terms of their current expansion strategy, mainly into the men's market and also the Chinese market, will bring that next level of growth curve for Lululemon. So when applying a 10% discounting rate in terms of this projection, you get a price target of roughly $305 per share, and that's a 15% upside. And this is really my baseline projection for Lululemon, and I do see a lot of tailwind going for this business. So I do expect quite a bit of growth resumption moving out into the next 2 to 3 years, and also margin expansion as long as they manage their brand image and value delicately, while also getting more people hooked into their entire ecosystem. Now, moving on to the second company on the list, which is Meituan. So their current storyline is this. They started as a high-growth, unprofitable, market share at all costs business. and some of their DNAs just don't change. So they did turn the corner in 2023 and they started turning operationally profitable. So they've already kind of monopolized the delivery market with a 70% market share and started turning outwards into other new initiatives or projects like Insta shopping, bookings, and overseas expansion. And over the last 5 years, you can see that gross margins have really increased very healthily from 30% to 38%, and operating margins from the used to negative percentages to now around the 9-10% range. Profit margins, free cash flow margins, they're all telling the same story. But I think the bigger problem here is that in 2025, at least in the previous 2 quarters, JD.com, primarily in the e-commerce space, their backside got itchy and they decided to mount an attack into the food delivery space as well. And in this quarter, as the management guided, it might be the last quarter that we see such nice, growing and healthy numbers, as they have already declared an all-out war to compete for market share and to be competitive in this entire space again. Some backward-looking numbers from Meituan in this recent quarter, they really grew very healthily year-on-year, 100% increase in operating profits. So top line growth rate still very healthy, 18% year-on-year growth. And here are some business updates in their latest disclosure. So their core local commerce actually remains a very dominant growth engine, easily lapping the 15 to 20% growth rate. But management did guide for significant year-on-year profit decline in Q2, primarily due to rising competition and also reinvestment. So Insta shopping, which is the retail on demand, is booming. They grew 60% year-on-year. There is strong momentum in categories like electronics, cosmetics, and pet products, which could potentially expand their long-term TAM, which is total addressable market, and stickiness of the app. So new initiatives like their Insta shopping, Meituan Select, they're up 18.5% year-on-year, and the operating margin loss actually narrowed to negative 10.2%. So it does signal some sort of an operational leverage kicking in. So they did announce a 100 billion RMB ecosystem investment plan, and this is a 3-year investment timeline, and it can be seen as some sort of fending off their rivals or a customer acquisition cost rising systematically, which will impact their margins down the line. So AI's involvement in their business is also playing a very important role. The internal large language model actually now generates 52% of the new R&D quotes, and their new AI tools, including AI food image search, restaurant site selection support, is also playing a much more pivotal role into locking the people into Meituan's ecosystem. And their membership program, including merchant subsidies and delivery discounts, already has tens of millions of users, and they're driving higher order frequency and AOV, which is average order volume. So if executed well, I think we'll see this translate very well into their numbers to come, especially in terms of their top line user growth metrics, total order volume, etc., etc. So they are also looking into overseas expansion with Kita, namely in Saudi Arabia, Hong Kong, and Brazil. Yes, the market is still small, but expansion in reinvestment and capex is to be expected. So the users and merchant ecosystem is growing very strong under the Meituan umbrella. They have over 500 million transacting users and 9 million active merchants on their platforms today. Their financial health has never been stronger. They're currently in a net cash position, with cash on hand growing 30% year-on-year and signaling their desire and also their readiness to fight off or to fend off many of this competition. And maybe also just to share a little bit in terms of my understanding of their end goal as a business. So this was my tweet storm on X recently. So I've recently been delving into Meituan's business, and this is my current working theory. So most people think Meituan is just China's DoorDash. But if you look closer, you'll see it quietly becoming much bigger. So it started with food delivery, high frequency, sticky, and brutally hard to win. Meituan dominated in logistics, algorithmic routing, and scale. Now, it's expanding far beyond meals and into nearly every transaction of an urban consumer's life. So you can think of hotels, travel, gyms, driving school, adult education, so on and so forth. Now, they're also into installment payments, AI merchant tools, and cross-border e-commerce. So they're no longer just doing food delivery. And Meituan's real ambition, I do think that they want to be a toll booth between every Chinese consumer and the physical world. As long as there's a transaction, Meituan wish to insert themselves into it. So you search, you book, you pay, all inside the app. And Meituan clips a tiny fee from the trillions flowing through. So their latest playbook looks like this. Start with food delivery, which is high frequency, expand into higher ticket services like hotels, education, beauty, lock in merchants with the traffic and tools, embed payments and financing, launch a Prime Style membership, and they scale overseas. So if they succeed, Meituan actually becomes a real-world operating system for the urban consumer life. And all of this is rolled into one interface layered with AI and data advantage. So this is basically how I look at Meituan's endgame and how in their current execution, it seems to me like they are trying to go towards that direction. So my conclusion on these two names, specifically for Lulu, I think I do still retain a pretty optimistic view about the future with many of the anecdotal evidence, especially when I visit Lululemon stores or when I look at just fellow male consumers. A few of them, at least two of my closer friends, are getting sucked into the entire Lulu ecosystem. Once they went to Lulu, they didn't go back, and their wardrobe is just recycling Lululemon's outfits. Now, I think a lot of the investors' attention is focusing mainly on this idea of margin erosion, whether it's cyclical or structural, mostly revolving around its ability to raise prices and mitigate the cost or tariff inflation. And the million-dollar question, have we hit peak margins for Lulu's business? So their US business is clearly hitting a plateau, and could they revitalize, or is it permanently losing brand mindshare? So it still remains as a China plus play in my own books, i.e. it's heavily influenced by the Chinese market and the entire growth outlook is being carried by the Chinese consumer. So they need to grow enough to offset the slowdown in other areas. I think current valuations are pretty much justified, and I'll look to average in if Mr. Market continues to punish them, for the risk associated, of course, and to build up a much more sizable exposure because Lulu still remains 1.5% on a portfolio basis for myself. Now, moving on to Meituan, I think for myself, the more I look at Meituan, the more I understand and favor the business. Hence, me building out this Meituan position quite aggressively. For now, I don't think I'll be adding on in big sizes anytime soon. Of course, unless Mr. Market wants to give me the opportunity to add. So numbers from the upcoming quarters might not look as palatable, which is why I was quite surprised that Meituan didn't continue tanking after the earnings, and they kind of rebounded quite sharply. I don't really see JD being able to mount a very good and surprise attack into the food delivery business, considering the fact that Alibaba has not done a very good job, and also with the recent regulators stepping into the delivery business, telling them to have fair competition, but not just burn money obsessively with no end in mind. So I do look forward to the market punishing Meituan, so I can scoop up more shares in the upcoming few quarters as they post more so-called quote-unquote disgusting results. So do share with me on what's your thoughts on both Lulu and Meituan, and I'll see you guys in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.